Assalamu alaikum and very good evening. I was thinking to teach something who are interested. In the next few weeks, I will be talking about techno-economics and life cycle analysis. As part of the techno-economic analysis, today I'm going to teach you how we can do the cash flow modeling. So usually cash flow modeling is done for analyzing whether the project is going to be profitable or not. Mostly industry people are doing that, but this can be a good exercise for students as well who are willing to do the techno-economic modeling. So since I'm working on hydrogen energy, so I will be doing the case study for hydrogen energy. So let's start. Before explaining in detail, you should know there are two main ways to do the cash flow analysis. One is called project IRR and another one is called equity IRR. So in this part of this lecture or tutorial, I will be discussing about project IRR, and later on in another tutorial I will be showing you how we can do equity IRR. So starting from the left hand side in cell A, these are the parameters you need to have in order to do this analysis. Now, firstly, as you can see, the project information, land price, salvage fraction, capex. So here these are the two parameters highlighted in yellow, which is capex and opex. So these are the two key information you need to have, and our rest of the information we will be deriving from these two and some other parameters which we need to assume. These are highlighted in yellow. So let us assume the capex is 717 million. So there are logic for this, which probably you can find from the books based on the production capacity. So I will be sharing the reference later on, and feel free to email me or get in touch regarding the references or this sheet. I will try to upload this sheet as well in the comment box or in the in the link. The link will be given in the post. So the capex is 717 million. The opex is 454 million. So land price is usually assumed as the 5% of the capex. So if you do the 5%, then you're going to get 35.85 million. And the salvage fraction is something like how much you can get at the end of the project when it is scrapped. Like another name is called scrap value of the plant. So which is assumed as a 1% of the project. Okay. So depreciable capex, there is a formula to calculate it, which is like capex minus land price times 1 minus salvage fraction. So these formulas you can get from the books as well. So construction period is assumed to 2 years. Then hydrogen price, I assumed it as a $3 per kg, but I have given the drop down here. You can choose 1 to 5, or if you want to increase, but you can do that. So, and this is a per kilogram. Let us make it per ton, which is 3000 ton. And while producing hydrogen in the plant, at the same time we can produce nitrogen as well, depending on the process or the technology you use. So let us assume the nitrogen price is $600 per ton, We assume the production rate of hydrogen per year is 12 128 thousands 128.505 thousands ton, or if I say 128 kiloton per year. So this is basically these data are collected from the process modeling flow sheet which we did for using Aspen. So nitrogen production rate is this amount, like 595 kiloton per year, and interest rate, let us assume 15%, but I have given the drop down depending on your choice. You can choose this in the different values. Then cost of equity, assuming to be like by default 9%. Although this will have no use for this one. Then plant life 20 years. Usually it's 20 to 30 years, so you can choose. Corporate tax is assumed to be 13%. Discount rate, so this has no use for this one. Usually I will use this one, so you can ignore this one. Sorry, this one, discount rate. So debt is 0 because it's a project IRR. You can learn how what's the differences between project IRR. Just to in short, just to let you know, so the debt is assumed to be 0 in project IRR because we assume that all the money is coming from the project itself. We are not bothering about the finance, where the finance is coming from. So it is assumed that all the money is coming from the project itself, and we are not taking loan from bank or any other sources. So that is called project IRR. Or in other words, it can be said that the project IRR is done, or analysis is conducted before considering when where the money will come from. Okay, so equity, that means all the monies are coming from project, which is equity is 1, that means 100%. So now we assume 5% is the working capital. Okay, 5% of capex. So tax payable after 5 or 5th year of the project, which is assumed to be 8%. Depending on your country, it can be varied. And also this 5th year, which is assumed considering, like it depends on the country. In Australia, there are like subsidies to the startup companies. Depending on the types of the project, they will offer you the tax payable after a certain period of time, like 5 years or so. So then depreciation method, which is called, there are 4 depreciation methods I have considered. Number 1 is linear. Secondly, SOYD, which is called sum of year digit. You can find the definition in internet or in books. And then double declining balance, DDB. And then finally MACRS, which is called modified accelerated cost recovery system. So these are the 4 methods usually used for depreciation analysis. And finally, this is discount rate or internal rate of return. So this would be an important parameter to check whether the project is viable or not. So once we have finished the calculation, we will see the variation of this and checking the results. Just to let you know, these are the interrelated parameters, discount rate and IRR. So these are the 2 equations. Basically this is a single equation, but once we use the net positive value 0, then it is called IRR instead of discount rate, which is R is given in the top equations. So which means when the net positive value is 0, then the discount rate is named as internal rate of return or IRR. Okay, let us start from the year. So firstly you have to put the year, like the year you want to do the analysis for. It started at 2024 to 2051, which is 27 years, as you can see. So, and then the working capital. So working capital, we the first 2 years is assumed to be the cost construction period. We have mentioned it here somewhere here. Construction period is 2 years. That means the working capital for these 2 years is 0. 0 means 0 years at the beginning, and this 0, this is 1 on first year, beginning of the first year, this is beginning of the second year, and this is end of the second year. So that means these 2 years the working capital is 0, and in the third year we need to have the working capital to produce hydrogen or the products. So which is assumed to be 33%, okay, of our OPEX. We assume this to be 1/3 of one OPEX. Okay, now then calculate the capital investment. So the first year is like beginning of the project is a 0. In the first year, this we assume the capex should be divided equally into 2. That means the first year of the project 50% of the capex, second year 50% of the project. Okay, so and the rest are 0. So capital investment is done. Working capital is achieved in the very first beginning of the third year to start the production. Now cash inflow, we can do the do the calculations how we can generate the revenue. As you can see, revenue is the amount of selling price of your products, and in this case our products are nitrogen and hydrogen. So as you can see, so this is the hydrogen and this is the B13. B13 is our hydrogen production per year, and B11 is our hydrogen price per ton. So, and this one is the price or the revenue generated from the nitrogen, and this is from the hydrogen. So if you sum up them, then you're going to get the total cash flow, and 10 to the power minus 4 is because of making it in million, convert it into million. So this is the cash flow throughout the year. We assume the production rate should be constant throughout the plant life. Okay, and then scrap value. Scrap value, we assume this there is no scrap, making it 0 for up until 26 years, and when the project is done and it's completed, the scrap value, we assume that, as you can see, which I discussed at in the beginning, this is the equation to calculate the scrap value from the salvage fraction. Okay, you can just check the cells and then figure out the equations. I'm not going in detail. Okay, so and then let us assume the operating cost. Operating cost is nothing but the OPEX, which we have assumed is 5454, and that will be constant for throughout the plant life. Now calculate the gross cash flow. So gross cash flow, as you know, so we did the capital investment in subsequently first year and second year. So this should be the negative because this is the investment, and then we generated revenue in the third year. Okay, so you know how to do the revenue calculation, which is G5, which is our working capital. Okay, so our cash flow, which is our revenue, subtract the working capital, which is our investment, and OPEX, which is again the expenditure, and capital investment if you have any. So this will give you the gross cash flow, and so this will continue up until end of the project. Now you calculate the net income before tax. Okay, so net income before tax will be the same as the gross cash flow. And now you calculate the capital depreciations. Okay, capital depreciation, as you know, the first 2 years will be 0, and this depreciation depends on the way or the method you choose for depreciation method, depreciation calculations. So I have given you the equations here, all the equations. If it is linear, I have given a bit of equations here, coding here, like linear, SOID, DDB and MACRS. Depending on your selections from here, the calculation will be, the capital depreciation will be calculated. For example, if I choose, for example, this is MACRS process, MACRS method. So as you can see, 67, then slowly going down to 33. And if I choose this to be linear, for example, then it's all through 33. It's just dividing by the year. Okay, so dividing by the number of years. Okay, as you can see, depreciation capex, which is our B6, dividing by B17, which is our plant life. This is a linear method, just dividing the depreciation capex divided by plant life. On the other hand, so there are equations here, so you can go through these equations for other depreciation method. Let us assume this to be double declining balance method. As you can see, this value changes. Okay, this value changes. So let us assume this is the MACRS process, MACRS method. Now you calculate the total taxable income. Okay, so total taxable income is this one, net income before tax minus capital depreciation, because this will not be counted, the depreciation value. So net income, and from net income you have to subtract the depreciation value, because this is not taxable. Now corporate tax is another one. Corporate tax is 13% we assumed, as you can see in the cell B18. So this is the formula, is this formula is because we assume this should be non-negative. Okay, therefore it's a max 0 formula is used. And B18 is our what you call this corporate tax percentage, which we assumed 13%, and this 13.01 is making it percentage, and M13 M3, or this total taxable income, is multiplied with this tax percentage. Okay, and then cash flow. Now you do the cash flow, which is M3, which is our total taxable income, plus L3, which is our capital depreciations, minus corporate tax. Then you can get the cash flow. Now you know how to do the cumulative cash flow. So this one plus this one is this one, like this. Okay, you know how to do the cumulative summations or cumulative analysis. Now this is important one before completing. This is a discounted cash flow. This discounted cash flow is done to convert the future cash flow into the current value, because in future the $5 would be can be assumed to be like $2 or $3 depending on the inflation rate. Therefore we are converting the future cash flow into the present value of money. Okay, as I have given them the example, like if I consider in future I will get $100, but in the current context this $100 is not $100, rather is going to be, for example, $80 if the like inflation rate is about 20%, something like that. It's not straightforward the inflation, but it can be assumed for simplicity. Okay, let's move on. Finally we do the cumulative discounted cash flow. You know how to do that, like this one plus this one is this one. Okay, now let us check the results. So we plot the results of our cumulative cash flow and discounted cumulative cash flow in terms of the year. Okay, so we can see the variations depending on the internal rate of return or discounted rate. If this is at 25%, so let us start from the 0.05, that means 5% of the IRR. So if it is 5% IRR, you can see within 5 years, like 5 years few months, let us assume the 6 years, in discounted cumulative cash flow, which is in orange, we can be in the positive side of the cash flow. That means this can go positive after 5 years of your project life. So what does that mean? If you your discount rate is increased, for example 10%, so that means your cash flow is decreasing. Let us check 0.25. Okay, so that means if it is 0.33, if the discount rate or internal rate of return is 30%, or then we can see the project is not profitable. That means it will take about 15 years to reach in net positive. It's not net positive, but the cash flow become zero, which is net positive value becomes zero. That means this is the IRR. As you can see, now discount rate is considered to be IRR, which is 30%. Up until 0.3, this is discount rate. Okay, so the discount rate, when it is 30%, then net positive value becomes a zero and project is not profitable. But when can you say the project is profitable? Only when it is less than 0.3 or well below 0.3. Let's say it's a 25% discount rate, or yeah, at this moment it's a discount rate because the net positive value is not zero at the end of the project. So at 25% discount rate, the project is profitable, but it's not attractive. See, it's a very low profit, like the cash flow is significantly low. But if is 0.3%, 0.03, then see how profitable, how attractive the project is. So this is what it signifies, whether the project is profitable or not. So these are the few methods, the few way you can analyze your investment, whether the project is going to be profitable, by changing like depreciation method, by changing discount rate, by changing your price or the cash flow revenue, which is the price of your hydrogen and price of your nitrogen in these cases, and some minor parameters like salvage fraction and so on and so forth. This will not impact too much, but these are the key parameters you need to consider before investing in any project, which is discount rate or internal rate of return, and something like what you call this depreciation method and the price of your product. Thanks very much for watching. I hope to give you more explanation on equity IRR, which will be the second one. Till then, I wish you all the best, and stay in touch. I will be uploading more videos on techno-economic analysis of how we can do the techno-economic analysis for hydrogen production or any kind of production in the plant. Not necessarily it should be hydrogen, but I will do the case study for the hydrogen because this is my field. Like how we can do the levelized cost analysis for hydrogen production, hydrogen transportation, hydrogen storage, different kinds of storage, and so on and so forth. Stay in touch. I say thank you very much for watching. Hope to see you next time. Thank you very much.